Hello everyone, welcome to another video. In this video, you are going to attempt a question for depreciation where you will calculate the profit or loss on the sale of a non-current asset and then find the total depreciation of all the motor vehicles that we have in the financial statements at the end of the financial year. So as always, you'll see the question on the left-hand side of your screen, and on the right-hand side, all the workings are done, which I'll go through step by step. So with that being said, let's begin. Joseph is a sole trader who started his operations on 1 June 2014. On 1 July 2014, he purchased two motor vehicles costing $40,000 each on credit from Forward Truck. All right, so the second line says that on the 1st of July 2014, we purchased two motor vehicles costing $40,000 each. All right. So be careful when you read the question. So we have got two motor vehicles and the cost of each motor vehicle is $40,000, which means altogether we paid $80,000. All right. The second paragraph says that Joseph subsequently sold one of the motor vehicles for a check of $8,000 on 31 March 2017. On the same day, he bought a new replacement motor vehicle for $35,000 and paid using check. The business policy is to depreciate the motor vehicles at 25% per annum based on the net book value. So in other words, this is the reducing balance method that we are talking about. A full year's depreciation is charged in the year of purchase and no depreciation is charged in the year of sale. All right. The first requirement of the question is to calculate the profit or loss on the sale or disposal of the non-current asset. All right, so let's look into the workings, which you'll see on the right-hand side of your screen. Okay, so we understand that the financial year of the business that we're working with starts on 1 June of a given year and ends on 31 May of the following year, which means for the current question, we have the financial year starting on 1 June 2016 and ending on 31 May 2017, which is the most recent period. And the way I know it's the most recent period is based on the second part of the question, which wants us to find the depreciation for the year ended 31 May 2017. So this is the most recent financial year that has just ended, which is 31 May 2017, which means that the financial year had started on 1 June 2016. All right? Okay, now let's talk about the disposal of the non-current asset. We know that one of the motor vehicles which we had purchased on 1 July 2014 for $40,000, all right, one of these motor vehicles had been sold, which means the original cost of the motor vehicle that we had sold is $40,000, and that is the basis of our calculations as we move forward. So year one of usage for these motor vehicles will be from the day of purchase, which is 1 July 2014, all the way until 31 May 2015. Although this is not 12 months exactly, based on the company's policy, we understand that we're applying a full depreciation in the year of purchase, right? So let's calculate the depreciation in the year of purchase, which is the first year of usage. So in the first year of usage, you apply the percentage on the original cost. This is the same regardless of whether you're using the reducing balance method or the straight line method. Always remember, in the first year, we find the depreciation by multiplying the percentage with the cost. And we are finding a full depreciation for the year. So there's nothing to apportion or allocate based on the number of months. So the full depreciation is percentage multiplied with cost, which is 25% multiplied with $40,000, which is the original cost. And that gives us a depreciation of $10,000. All right. Whenever we are using the reducing balance method, always remember to find the net book value at the end of the financial year. So we want to find the net book value at the end of 31 May 2015. And the net book value at any given point in time is the difference between the original cost and the accumulated depreciation. So the original cost, as we know, is $40,000, and the accumulative depreciation, which is also known as the total depreciation, so far up to this date, which is 31 May 2015, is $10,000 based on our calculations. Okay, so that leaves us with a net book value of $30,000. All right, and this net book value is at 31 May 2015, which is the end of the first year of usage for this non-current asset which we had disposed or which we had sold. All right, so moving on to the second year. The second year will start on 1 June 2015 and end on 31 May 2016, right? Depreciation, when you're using the reducing balance method, in the second year is calculated by multiplying the given percentage with the net book value. And that was the whole purpose of why we found the net book value at the end of year one. So the given percentage, as we know, is 25. 25% multiplied with the net book value of $30,000, which we had at the end of year one or at 31 May 2015. And that gives us a depreciation of $7,500 for year two. How do we find the net book value at end of year two or at 31 May 2016? We take the previous net book value that we had at end of year one, which is $30,000, and subtract an additional $7,500, which is the depreciation expense that we have incurred in year two, and that leaves us with a net book value of $22,500. All right. Now, let's move to the third year. The third year is the most recent financial year, which we're mainly concerned about within this question. And the third year would start on 1 June 2016, right? And end on 31 March 2017, the day we had sold this machine, which is the second paragraph, first line, as mentioned. Joseph subsequently sold one of the motor vehicles for a check of $8,000 on 31 March 2017, all right? So based on the company's policy, as mentioned in the very last line of the entire question, which is to charge no depreciation in the year of sale, we have no depreciation being charged in the year of sale. Okay, so let's now find the profit or loss. How much did we sell this machine for? How much did we sell this motor vehicle for? $8,000, all right? And where did we get this information from? Second paragraph, first line. Joseph subsequently sold the motor vehicle for a check of $8,000. This $8,000 is known as the disposal proceeds, or the amount that we have received in our bank account by selling this machine, by selling this motor vehicle. All right. Now, when we sold this motor vehicle, the value, the net book value, the economic benefit that we still had left within this motor vehicle was $22,500, right? And we ended up selling it for very less at $8,000, which means we ended up selling it for significantly lower price than what it was worth, right? Therefore, we can say that we've made a loss on disposal, and which is simply the difference between $22,500 being the net book value that we still have left to consume, minus the $8,000, the disposal proceeds, or the amount that we have received in our bank account by selling this machine, and that leaves us with a loss on disposal of $14,500. All right? Okay. So I believe that is clear for all of you. So let's move to the second part of the question, which is to calculate the total depreciation of the motor vehicles for the year ended 31 May 2017, which is the most recent financial year that we're talking about. All right. So before we go any further, all right. So at the very beginning of the question, we knew that we started the year with two motor vehicles, right? And each of these two motor vehicles were purchased on 1 July 2014, and we bought each of these motor vehicles for $40,000, okay? And one has already been sold during the financial year, which means one is now left, okay? So the one motor vehicle which is now left, and that motor vehicle which was purchased on the same day for the same cost of $40,000, and which is also depreciated at the same rate and also at the same method, should basically have the same depreciation that we had already calculated for the previous motor vehicle we had sold in years 1 and 2. Make sense? All right. I've still broken this step down to just show you how it adds up to be the same depreciation as the motor vehicle which we had sold. All right. So this one motor vehicle, which is left from the old group or from the old batch. So the year one would have been from 1 July 2014 until 31 May 2015, in which we would apply a full depreciation based on the company policy, and therefore we're multiplying the given percentage with the cost, which is multiplying 25% with the original cost of $40,000, and we would have got $10,000. All right. And the net book value at the end of year one or at 31 May 2015 would be the difference between the original cost of $40,000 and the accumulative depreciation at that point in time, which is $10,000, which would give us a net book value of $30,000 at 31 May 2015. And this is exactly the same as what we have seen in the part A of our calculation. Moving on to year two. So year two would start on 1 June 2015 and end on 31 May 2016. And because we're using the reducing balance method, which the question explicitly mentions to depreciate at the net book value, so we are multiplying the given percentage with the net book value. So we are multiplying 25% with the net book value of $30,000, which we had at 31 May 2015 or at the end of year one. And that leaves us with a depreciation of $7,500. This means the net book value at end of year two or at 31 May 2016 is the difference between the original cost of, not the original cost, I'm sorry, is the net book value that we had at end of year one, which was 30,000, minus the additional depreciation of 7,500, which we had derived for year two, and that leaves us with a net book value of 22,500. Now moving on to year three, this is where this gets different compared to what we have done before, because we hadn't sold this machine. This machine was used for the entire year in year three, which means we must depreciate this machine in year three. Now, year three would start on 1 June 2016, which is the most recent financial year we're talking about, and ending on 31 May 2017. So the depreciation in year three would be simply the given percentage of 25 multiplied with the net book value that we had at the end of year two, which was 22,500. So 25% multiplied by 22,500 gives us $5,625 as the depreciation expense for this motor vehicle in year three. Okay? All right. So the net book value that we will have at the end of year three is 22,500, which is the net book value that we had at end of year two, minus 5,625, which is the depreciation expense that we had incurred for year three, and that leaves us with a net book value of 16,875 at 31 May 2017 for this machine or for this motor vehicle that was still left. I may have used the words motor vehicles and machine interchangeably, but you get the idea. So I'm talking about that one group of assets which we are working with in this question. All right? Okay. Now, we had also purchased a new asset, right? And this was given in the second, basically the last line of the second paragraph, which says that on the same day, he bought a new replacement motor vehicle for $35,000 and paid using check. All right. So there is a purchase of a new asset, and based on the company policy, we do a full depreciation in the year of purchase, which means if I want to find depreciation, I'll simply multiply the given percentage of 25 with the original cost of 35,000. So 25% multiplied by 35,000 leaves us with 8,750 as the full depreciation expense incurred for this purchase of new asset, which we have consumed in this most recent financial year ended 31 May 2017. So altogether, the total depreciation for motor vehicles is 8,750, which comes from the new asset, plus 5,625, which comes from one of the old motor vehicles, which was still left behind, all right, that we had calculated for year three. So altogether, the total depreciation is 40,375 for motor vehicles that we report in the income statement for the year ended 31 May 2017. Okay? All right. So let's move to part C. Explain why it is necessary for the business to provide for depreciation on the motor vehicles. All right. Now, when we buy motor vehicles for business use, we're essentially using it within the business operations. So we understand that the useful life that comes with these motor vehicles, all right, we are consuming the economic benefit or a portion of the cost over its useful life. And as we consume the economic benefit, we are using a portion of the cost. And this portion of the cost gets expensed, which is what we classify as depreciation expense. Now, under the matching theory, if you want to accurately find the profit at the end of the financial year, it's the difference between the revenues earned and the expenses incurred. So whatever depreciation expense we would have incurred through the usage and utilization of these motor vehicles within the business for the purpose of generating revenue would end up consuming the economic benefit, which would give rise to the depreciation expense, right? And this depreciation expense is a non-cash expense which must be included as part of your total expenses. Because if you do not include it as part of your total expenses, then your profit calculation won't be accurate. Profit, as we have mentioned before, is the difference between revenues earned and expenses incurred. And when we're using this motor vehicle in our business, it's helping us generate more revenue, okay? We do not just buy non-current assets. We buy non-current assets because of the economic benefit that we can consume, which helps us generate more revenue, okay? And that more revenue, which is being generated, also helps us calculate the profit. Therefore, the profit under the matching theory is simply the difference between revenues earned and the expenses incurred. And this is one of the reasons for why we can depreciate. We could also look into another theory, which is the prudence theory, all right? Now, what's the prudence concept? The prudence concept is simply assets are not to be overstated, profits are not to be overstated, liabilities and expenses are not to be understated, all right? So assets are not to be overstated. So when we are accounting for depreciation because of the consumption of the economic benefit from this motor vehicle, our expenses are going up, our depreciation expenses going up, which means our accumulated depreciation will go up and our net book value will go down, which gives us a reasonable estimate of the value that's still remaining within the asset. So that's why we're not overstating assets. And then our profits are also not overstated because the expense is being accurately determined based on the consumption of this motor vehicle in the business for the purpose of generating revenue. So we're not ending up overstating either our asset nor our profits, okay? So this is the whole purpose of why it's necessary for any business to provide for depreciation. And the two concepts that most accurately reflect this is the matching theory and the prudence theory. All right. Now, before we go, I also want to mention about the upcoming videos that I'm working on. So in the next videos, we will do a ledger account for accumulated depreciation and the sale of non-current assets. We'll learn to prepare the ledger accounts, which is the debit and credit, what to show on the debit, what to show on the credit, and how to do the balancing at the end. So we will work with those kind of questions in the next few videos. So I thought I would just let you know. So you can stay tuned for it, and I'll see you in the next video.